welcome to the REI Investor Talk Show. I'm Neale Petersen, and we cut through the hype with data, practical tactics, and also investable ideas. And today my guest is Grant Smee. He's the CEO of Only Realty Property Group, and we're asking the hard questions. Is Cape Town property becoming too expensive for locals, and what should buyers and investors actually do now? So Grant, great to have you.
Thanks for having me again, Neale.
No, good, man. So let's get straight to it. I mean, let's talk about the headline first. Is Cape Town pricing out locals? In plain English, what's really happening on the ground and who's getting squeezed the most?
So, yeah, I mean, I think, there's this broad topic about Cape Town becoming too expensive for most people in South Africa or most locals. And I think what it does, it actually comes down to the pockets of excellence that we've been seeing in Cape Town, the Cape Town property market. So your Atlantic Seaboard, the CBD are certainly very, very expensive spaces and certainly pricing out most locals. And then you go into the traditional areas, the southern suburbs, again, is one of those areas that's performed so well for so many years and is really expensive. So you do have these pockets where people are being priced out of the market, but then there are areas that are still affordable and are places that people should certainly consider if they're looking to move to Cape Town.
Okay, cool. So let's just look at the demand drivers versus, scarcity. I mean, we've seen over R1 billion foreign spend in I think it's about 5 months, and record sales in Clifton, Bishop's Court. How much of those price actions, of today is actually foreign money and semigration? And how much is actual structural scarcity, so limited land, slow supply, etc.?
So I think there's this narrative out there that foreigners driving the prices up in Cape Town, and that's the sort of the go-to for a lot of people. The reality is only less than 4% of all property purchases in Cape Town and the Western Cape are actually from foreigners. And if you think about that, those are then focused in those spaces, the Bishop's Court, southern suburbs areas, the Atlantic Seaboard and CBD. So, and then obviously the waterfront. So that's where the highest concentration of those foreign buyers is. That doesn't explain the rest of the Cape Town market. Talking Paarl, Stellenbosch, the Western Seaboard, Blouberg, those places, which are really experiencing extreme increases in price action. And that really comes off the back of obviously City of Cape Town, widely known as one of the best run municipalities in the country. There's really good governance. There's job creation in the area, and a lot of businesses are moving down to the space for various reasons, very entrepreneurial environment as well. And then you've got a very good lifestyle, as well as the limitation of the ability or limitation of land. We sit between a mountain range and an ocean, so it's very limited land from that perspective. So I think all those factors play to the increase in demand and the lack of supply. And then take into account very good schools, government schools, private schools, again, in the City of Cape Town. They're fantastic schools out here, which really brings people and families here as well, looking to buy. And that talk to that semigration narrative that was from post-COVID for the last 5 years, been really semigration. And now let's talk about this reverse immigration, but really there's still lots of people moving into Cape Town, either from upcountry, from Africa, or internationally.
Okay, good. So let's just talk about governance, because there's been a lot's been spoken about governance in Cape Town. We've seen that the Cape Town municipality or Western Cape municipality certainly outperforms their peers. If you just look at service delivery, permits, infrastructure, I know I was just at the SAPRO Awards and all the Western Cape municipalities walked away with the honours. And so let's put a number on it. How big is the governance premium, if you look at it baked into the pricing, and does it justify current multiples on the Atlantic Seaboard and southern suburbs?
So I think again, if you look at, let's go back and look at the reverse side, look at the Joburg market, look at sort of the Bloem market or other areas, PE market. Those prices have been heavily suppressed for such a long time, and there's really good yields from an investor point of view to buy into Joburg and buy into certain parts of Joburg or the East Rand, buy into PE. buying something else, but there's really good yields there for investors and people to buy properties. Yet price has been suppressed. And one of the biggest reasons I feel is that people don't have confidence in the municipality to help their property prices increase through good governance and good service delivery. Take that down to Western Cape, I think there's certainly a premium, and to add a percentage to it, I think is super difficult, but it really does play a massive factor in all areas. But I think it's not only the city of Cape Town that's doing very, very well, and like I said, they achieving all the awards, they're getting these clean audits, but I think it's also the work of the city with private sector. So, for example, the CCID, which is a big factor in Cape Town CBD, keeping the CBD safe, clean, and accessible to people. The CCID is run by mostly private sector, and yes, there is some municipal funding there, but at the end of the day, the board, the guys who head up that team, the guys who make decisions, are really private sector that are driving that. So I think it's this real strong collaboration between private sector in the Western Cape and local government that is really seeing positive strides and keeping demand high in the area.
Okay, valid point. And so maybe, where does that premium not justify the price? I mean, let's look at an area that you'd now treat with caution, because we have seen some overpricing in some areas.
Yeah, look, I mean, if we're going to the sort of the areas that you want to look to invest in a space, there are opportunities in your Wynberg Observatory, Musenberg spaces. I think there is issues around the ability for the council to control and effectively implement their sort of structures, because it's very easy to talk about Atlantic Seaboard, huge pricing, huge rates and taxes. Massive demand, very powerful people sitting there. CBD again is sort of the icon of the Western Cape. Everybody travels to Cape Town and wants to see the CBD. Southern suburbs again, very wealthy people, and again super powerful, and again big demand. But if you go into sort of cheap areas, let's use a Goodwood as an example. There's not necessarily a premium there. There is a issue around dilapidation of housings. People can't afford to move from Goodwood to other areas. So I think there are spaces where maybe the premium doesn't necessarily apply, although the council are, through this new cleaning tariff and other tariffs that they're implementing, are trying to raise money so that they can effectively control and implement their service delivery properly into these other areas where they're not necessarily collecting the same rates and taxes that they wouldn't elsewhere.
Okay, great. So let's talk about access for locals in terms of what will actually move the sales needle. I mean, three levers tend to get airtime. It's the foreign buyer surcharges, title, short-term rental rules, and creative finance like group buying. I mean, which two would most meaningfully improve local access in 12 months, and which one's just maybe political theatre?
Yeah, I think I think the real difficulty is, but South Africa's from a business perspective is heavily regulated, and it's super complex to do business out here. I think bringing in additional regulation, additional taxes, is something that maybe we don't want to be sort of venturing down. So taxing foreign buyers additional amounts to limit maybe the demand from foreign buyers, and particularly because it's such a small percentage of purchasing in Western Cape. I don't necessarily think that taxing foreign buyers is something that would deter buyers necessarily, unless you're going to add massive surcharges. But then how does that impact the local economy? It brings so much money into the country. So I think taxing foreign buyers for me is something that's spoken about, but I think maybe that is your political theatre. Airbnb regulations, I think, is certainly something that needs to be considered, and a structured approach to Airbnb. What it's done, Airbnb has done two things significantly. It significantly increased prices in areas where there's views and lifestyle, so taken away from locals. So, you can use the Western Seaboard, Blouberg, you can use Somerset West, you can use Stellenbosch, CBD, Atlantic Seaboard, all those areas. Short-term rental has certainly increased pricing because the yield created by short-term letting is so much higher. And part two is people buying units and then putting in the short-term market has taken units out of the long-term market, and therefore significantly increased long-term rentals because there's so much less supply. So that is an instance, and you can see that effect particularly around winter months when lots of these units come up rent for 4 months or 3 months or very, very medium term. So I think Airbnb regulation is certainly something that needs to come in. It's been effectively implemented in countries like Portugal and the UK. I think there can be a level of over-regulation there. So the city does need to be, or the city and the government needs to be very careful of not over-regulating it to really kill that market, because, again, tourism and travel and Airbnb itself brings so much into the economy. It's vitally important sort of lever there. But Airbnb regulation certainly. Innovative financing models, there's a few things around that. Firstly, the innovative financing models are much more around investment than home buyers. There is a big focus by the banks on first-time home buyers, where they're offering 100% or 105% bonds to help cover costs. So there's a drive there. But what that comes down to still is the underlying reality that that person needs to be able to afford the property and have an affordability level to pay that bond. So I think, innovative financing models certainly is something there, but that's very limited in sort of its application to help people buy properties. The last one, and then the last one is obviously from an investment point of view. From an investment point of view, F&B, as an example, are allowing people to 12 co-signatories to sign on a single bond. That's interesting from an investment point of view. It's complex in nature, and there's a whole lot of other complexities in having partners and 11 other partners in a business. But that's interesting in where F&B is going. Standard Bank are allowing more first-time buyers to come into the market. Nedbank are being very aggressive on first-time buyers, as are ABSA. So it's there's innovative financing models, but again, that's limited in terms of the underlying affordability of those people. I think the big thing that can be impact locals is actually the building of much more affordable stock. And I do know in the developers we work with, the city are actively pursuing that, where they want more affordable stock to be brought to market. They want less sort of luxury sort of developments and much more sort of affordable space. And that's what's getting sort of preference in terms of local planning. So the city are again actively working with private sector and the developers to make sure that there is that stock coming to the market. That's not going to sit in the CBD. It's not going to sit in Atlantic Seaboard, unfortunately. The land's just too valuable there, and the income that the city would garner from luxury properties would outweigh the benefit of putting affordable units into those spaces. But there are other spaces. There's a great development in Pinelands, which is really central. There's quite a lot happening in Observatory and those sort of spaces. There's, again, what's it called? Sort of up Tiger Valley, Brackenfell area. There's lots happening up there, which again is an economic hub for the city. So there's lots happening in the city to make sure that properties are affordable for people. It's not necessarily your beachfront property, but there can't be this expectation by the consumer that they're going to, for their first time home, going to have a beachfront property for no money as well.
Absolutely. So maybe let's give us a sort of a playbook for a first-time buyer couple on, say, a 1.6 million budget. I mean, what exact steps should they take if they invest this quarter?
Yeah, so I mean, I think again, you need to consider, and I've done an article on buying your investment property first before you buy a home. And I think there's a valuable lesson there. Is getting onto the property ladder is vitally important for any wealth creation in the future. But getting onto the property ladder doesn't necessarily mean buying a home first and then trying to buy investment property second. So I would say look at areas where there's value and there's underlying value at the moment. And there certainly are areas, I mentioned them earlier, but your Muizenberg, your Paarl, Claremont, Wynberg, Woodstock to a degree, and Observatory are areas that currently show good good price points, but decent underlying value. And with the rest of the city sort of increasing in value, and we've seen massive price increases over the last few years, those will certainly benefit. You can then achieve decent yields and decent rentals from those properties, and then maybe rent in a place that makes more sense for you from a location point of view. If you have kids in school, where you work, where you need to commute to, where your life and your family, your support network is, you rent in those areas. You need to do the numbers and make sure that they also do well for you. But first-time buyers, I think, need to start considering seriously to buy in areas where there's yield and live in areas and rent in those spaces, and almost be subsidized by landlords that own in those areas.
Okay, cool. So maybe just share in those sort of value areas that you just mentioned, what's the red flag in each of those pockets of areas that you mentioned? And I mean, what would make you walk away?
Well, so I mean, largely first-time buyers end up looking into sectional type complexes. That's where the most affordability sits. I would stay away from units that are where there's complexes where the financials aren't necessarily um, don't look very good, where there maybe are special levies in place, or the one thing that I always look at first is what is the levies in those complexes, because rates and taxes are one thing, but levies controlled by trustees can often be very, very high for relatively cheap units and can actually eat away at your yields massively. So look at the levies. We really want to be in a complex that is well maintained, well looked after. Again, we speak about good governance from the board, good financials. There's lots of things you need to look around a complex, how they run. So across all those areas, regardless, even if I was looking at Joburg or the East Rand anyway, that's the first thing I look at is I want to see the AGM minutes. I want to see, is there a lot of politics in that building? That's usually an indication of financial distress. Are there special levies that are proposed or are coming? How's the building maintained and how's it managed, and what are the levy rates like?
Okay, great. So maybe just finally, just let's look at some of the two biggest risks buyers really underappreciate right now. I mean, in terms of policy, I know you mentioned some of them now, but in terms of rates, rentals, or liquidity, and how should they hedge those risks before signing an OTP? Because we're seeing a lot of investors falling short. They're not being able to.
Yeah.
There's an affordability issue.
Yeah. So I think, you've got to consider the your ability to purchase and understand the numbers there. And that's literally sitting with your estate agent or your financing person, your bond originator, as well as the attorney, understanding the upfront costs that are required from a capital perspective, getting those pre-qualifications from from your bond originator would be super useful, so you understand what you can afford and where you sit. Looking after your credit history and your credit reports is vitally important. So making sure that you're credit worthy, so you don't fall short there. And then doing the numbers and really sort of calculating your levies, your rates and taxes, adding in maintenance that you might have to do over the year in terms of your numbers, adding in a vacancy period potential. We should generally use 10% vacancy. So I think it's important that you really run your numbers and be very clear, but also make sure that you have surplus cash should there be an issue. So, although it's rare if you do it well, a tenant that stops paying is something that you need to take into account. And the fact that it might take you 3 to 6 months to have that person evicted is something that an investor needs to consider seriously. There are insurances out there, but also be careful, taking insurances that might necessarily not pay out or so expensive that are actually prohibitive in terms of your returns. Property ultimately, as not a cash flow driver. It really is actually a little bit of a savings account for 20 years where you'll benefit from the capital that you have in that property later on. If you want to really look at cash flow, you're going to be looking at either short-term letting, which needs to be done well and done properly, particularly in Cape Town where you've got so many. I think there's at one stage there was 29,000 short-term units on Airbnb in the city, which is insane. And it's comparable to New York and Barcelona have very similar numbers. So it's massive for a little city at the bottom of Africa. But and then, or you can consider multi-let, which is, I suppose the best way to put it is student letting, where you have one property and rent it out to multiple tenants. I really like that model. I tend to stay away from students and look more at young professionals, because there's a few things there. Young professionals are earning an income. They're not students, they're not permanently departing, they are working. So there's benefits to being in that market, but that's more of a cash flow sort of element. So you need to decide on what you're trying to achieve from a business perspective. Are you looking for a future capital? Are you looking for current cash flow? Or are you interested in walking the road of short-term letting, which is ultimately a hospitality business and quite intensive on its own? And then again, it's always about running the numbers. Excel doesn't lie. At the end of the day, you might lie to it, but Excel doesn't lie.
Absolutely. Grant, I think thanks very much for the candor. I mean, for our viewers, we'll certainly link Grant's article with the value pockets and also a stress test checklist below that you can read on. Don't miss our next Investor Talk show. And I'm Neale Petersen along with Grant Smee, the CEO of Only Realty Property Group. Great chatting to you, John. I mean, Grant, buy on fundamentals, not FOMO. See you next time. Thanks, Grant. Good chatting to you.
Thanks.